Most people will spend the better part of their working lives handing money to institutions that were never designed to make them wealthy. They will pay interest to banks, surrender returns to intermediaries, and arrive at retirement wondering why 40 years of discipline produce something that feels so much smaller than it should. Benjamin Graham watched this pattern repeat itself across generations. And unlike most people who noticed it, he refused to accept it as the natural order of things. Graham was not simply the greatest investment analyst of the 20th century. He was something rarer than that. He was a systems thinker who looked at money the way a surgeon looks at anatomy. Every part has a function. Every function either serves the organism or damages it. And the moment you develop the ability to see which parts are serving you and which parts are quietly working against you, your entire financial life begins to operate differently. What I want to share with you today is not a collection of tips. It is not a shortcut. It is the practical application of Graham's core intellectual framework to the private financial decisions you make every single year. 3 specific, legally sound, time-tested mechanisms that keep capital inside your own ecosystem, compounding inside your own system, working for you instead of for institutions that profit from your inattention. This is the financial education that Graham's thinking points toward, the kind that most people never receive, not because it is complicated or restricted to people with a certain level of wealth, but because nobody has ever explained it to them clearly, honestly, and without a sales agenda behind every sentence. Stay with me, because by the time this is over, the way you think about capital will have shifted in a way that cannot be undone. Graham grew up watching his family lose everything in the financial panic of 1907. His father was already gone. His mother had been managing on her own, and then even that was taken. A boy who had no business thinking about money at that age found himself unable to think about anything else. Not out of greed, out of survival, out of a determination to understand why the system worked the way it did and whether the rules were actually fixed or whether they only appeared that way to people who had never examined them closely enough. Decades later, standing in front of students at Columbia University, he delivered the insight that would become the foundation of the most successful investment philosophy ever documented. He told them that the market is not a weighing machine, it is a voting machine. It does not tell you what something is worth, it tells you what people feel about it at this particular moment. And feelings, especially at the extremes, are almost always wrong. Price and value are 2 entirely different things. That single idea, held with discipline and applied with patience, separated Graham and his students from every other participant in the financial markets of the 20th century. But almost nobody has taken that same logic and applied it to their own private financial structure, to the cost of the capital they borrow, to the interest they pay every month, to the question of whether the financial systems they participate in are actually serving their interests or simply the default arrangements that nobody ever thought to question. That is exactly what we are going to do today. Here is the mental model I want you to carry through everything that follows. Think of your financial life as a balance sheet. On one side, assets that grow. On the other side, obligations that drain. Every financial decision you make either shifts more weight toward the growing side or quietly feeds the draining side. Most people never look at their financial life this way. They look at monthly cash flow and nothing deeper, and because they never examine the balance sheet, they never see the structural inefficiencies compounding against them year after year. Banks understand your balance sheet better than you do. They take your deposits, pay you almost nothing on them, and lend that same capital out at dramatically higher rates. The spread between what they pay and what they earn is their entire business model. It runs every single day, automatically, whether you are paying attention or not. Graham's insight, extended into personal finance, is this. What if you applied that same logic to your own life? What if you built a structure where you controlled the spread, where capital stayed inside your ecosystem, interest income belonged to you, and the compounding worked in your favor instead of in the favor of institutions that played no role in creating your wealth? That is what we are building toward today. 3 tools, each one a direct expression of Graham's foundational principle. Understand what something is actually worth. Pay less than that. And let the math do the rest over time. Let us start with the first one. And I want you to bring to this the same quality of attention that Graham brought to every asset the market had mispriced. An open mind, a willingness to look past surface reputation, a commitment to understanding what something actually does rather than what people assume it does based on how it has been sold to them. Permanent life insurance, structured correctly, is one of the most powerful private capital tools available to any individual investor. I already know what happened when you heard that. A significant portion of you pulled back instinctively. That reaction is completely understandable because the life insurance industry spent decades earning it by selling the wrong products to the wrong people for the wrong reasons. But Graham spent his entire career finding real value in exactly the places where reputation and underlying reality had separated the furthest. So let us look at what this tool actually does when it is structured correctly. When you take out a permanent life insurance policy and deliberately overfund it, meaning you contribute significantly more than the basic cost of the coverage itself, that excess capital accumulates inside the policy as what is called cash value. It grows, it compounds, either linked to a market index in a structure called an index universal life policy, or through dividends from the insurance company's own portfolio in a whole life structure. Either way, it grows with tax treatment that almost no other financial instrument available to a private individual can replicate. But the feature that changes the entire equation is this. You can borrow against that cash value, not withdraw it, borrow against it as collateral, and that distinction is the entire point. When you take a loan against your cash value, the proceeds arrive in your hands completely free of income tax. You are not liquidating the asset, you are borrowing against it. The IRS does not treat that as a taxable event, but that is still not the most important part. The most important part is what happens inside the policy while you are holding that loan. The cash value continues compounding as if you had never borrowed against it. The full balance keeps growing at whatever rate it was growing before. Meanwhile, you are holding the borrowed capital in your hand, free to deploy it wherever your analysis tells you the return is highest. Graham would look at that structure and recognize it immediately. You have an asset growing at one rate, you have borrowed against it at a lower rate. You have deployed those borrowed funds into a return that exceeds the borrowing cost. The spread between those three numbers is structural leverage that compounds quietly over decades. Let me give you the numbers so this stops being abstract. Your cash value has reached $200,000, growing at 7% annually. You borrow $120,000 against it at a policy loan rate of 4%. You deploy that capital into a real estate investment generating 12% annually. You are now earning 7% on $200,000 inside the policy. You are earning 12% on $120,000 in the investment. You are paying 4% on the borrowed amount. That spread exists on two separate pools of capital simultaneously. That is the arithmetic banks run every single day. The difference is that now it is running inside your structure, not theirs. One warning that Graham would insist on delivering. This tool is massively misused by the people who sell it. Agents earn higher commissions when the death benefit is larger. A larger death benefit means more of your premium goes toward insurance cost and less goes toward cash value accumulation. If you are using this as a capital building mechanism, you want the exact opposite. Maximum cash value accumulation, minimum death benefit consistent with what the law requires to preserve the tax treatment. Before you sign anything, examine the cash surrender values in the policy illustration year by year. If you contribute $50,000 in year one and the surrender value shows $35,000, that $15,000 gap transferred to someone else. Ask specifically to see the internal rate of return on the cash value. Request multiple illustrations. Be skeptical of any advisor who spends more time on the death benefit than the cash value growth trajectory. Graham's margin of safety principle applies here as forcefully as it does in any equity analysis. Before you calculate the upside, protect against the downside. Now let us move to the second tool. Before I describe it, I want to address the objection already forming in your mind, because it is the same reflexive rejection Graham encountered every time he presented an undervalued and misunderstood asset. Why would any rational person borrow from their own retirement savings? Because there is a categorical difference between a retirement account withdrawal and a retirement account loan. And almost everyone confuses the two. A Withdrawal is genuinely damaging. You pay ordinary income tax on the full amount. If you are under 59 and a half, you also pay a 10% early withdrawal penalty. Depending on your tax bracket, you could lose 30 to 40 cents of every dollar before it reaches your hands. That is not what I'm describing. A loan is an entirely different transaction. The IRS treats it exactly as the word implies. You borrow from your own account, you repay it with interest on a defined schedule. At no point is the money classified as a distribution. No income tax, no penalty. The capital moved from your account to your hand and is on its way back. The retirement system was never actually exited. Here are the mechanics precisely. Most 401k plans that permit loans allow you to borrow up to $50,000 or 50% of your vested balance, whichever is smaller. The repayment window is typically 5 years. The interest rate is generally set at the applicable federal rate, which in current conditions sits around 4 to 4.5%. And here is the detail that almost never receives the attention it deserves. You pay that interest back to yourself. Every dollar of interest goes back into your own retirement account, not to a bank, to the future version of you who will eventually live off that capital. Consider this scenario. You have $200,000 in your retirement account growing at 10% annually. You are also carrying $50,000 in credit card debt charging 22% interest. Every month that debt exists, it is compounding against you at a rate nearly impossible to outrun through investing alone. You borrow $50,000 from your 401k at 4.5%. You eliminate the credit card balance entirely. You are now paying 4.5% to yourself rather than 22% to a bank. The difference between those two rates applied to $50,000 is not a marginal improvement. It is a structural transformation of your balance sheet. And when you repay that loan with interest, every dollar of interest enters your retirement account as additional capital. Your future self receives the full benefit of every dollar your present self paid. The same capital is serving two purposes simultaneously. Graham would recognize that immediately as the kind of structural efficiency that disciplined investors build into their systems and that everyone else walks past without noticing. One honest boundary worth naming. This tool is best suited for short-term capital needs. Eliminating high-cost debt, bridge financing on a transaction, initial business funding. The 5-year repayment window is a real constraint that must be respected. And if you leave your employer before the loan is fully repaid, the outstanding balance may become due on an accelerated timeline. Know the specific terms of your plan before you borrow. But for the right situation applied to the right need, this is fast, low-cost, tax-neutral capital with no external institution involved in the decision. The third tool is where the distance between people who understand private financial architecture and people who do not becomes the largest, and it most directly reflects the systems thinking that defined everything Graham ever did. If you own any business entity, a corporation, a limited liability company, any closely held structure, you have the legal ability to create a private lending relationship between entities you own and control. Your holding company can lend to your operating company. A capital reserve entity can lend to your active investment vehicle. A protected structure can lend to an entity taking on transactional risk. This arrangement achieves multiple objectives simultaneously in a way no single conventional financial product can replicate. The first objective is keeping interest income inside your own ecosystem. When one entity you own lends capital to another entity you own at a properly documented interest rate, that interest income remains entirely within your financial universe. The borrowing entity deducts the interest as a legitimate business expense, reducing its taxable income. The lending entity receives that same interest as income. You control both sides. Not a single dollar of that interest enriches an institution that played no role in creating your wealth. The second objective is where Graham's thinking about risk-adjusted returns becomes directly applicable to how you organize your entities. Here is the logic. You have capital sitting in a protected entity with no active operations, no employees, no contracts, no legal exposure. It simply holds capital. You want to deploy that capital into an active transaction carrying real risk. Instead of having your protected entity directly own the risky transaction, which would expose the full capital balance to that deal's outcome, your protected entity lends to the active entity. The active entity absorbs the operational risk. Your protected entity holds a secured promissory note against the assets of the active entity. If the deal fails, your protected entity is not an equity holder absorbing losses. It is a secured creditor with a legal claim carrying priority over general creditors and equity holders. You have separated the capital from the risk at the structural level. The money is still in the game, still generating a return, but protected in a way direct ownership could never achieve. Graham argued his entire career that the intelligent investor does not pursue the highest available return. The intelligent investor pursues the highest risk-adjusted return. Now, this structure is that principle expressed not as a portfolio decision, but as an architectural one. One requirement that cannot be softened. The IRS scrutinizes transactions between related parties. You cannot construct a lending arrangement on paper with no economic substance and treat the interest as a legitimate deductible expense. To make this structure valid and durable, you need a properly executed promissory note with a stated loan amount, interest rate, repayment schedule, and specified collateral. The interest rate must meet or exceed the applicable federal rate the IRS publishes monthly, currently in the 4 to 5% range, and repayment must actually occur on the documented schedule. Real payments, real bank transfers, real records on both sides. This requires attorneys and accountants who understand related party transactions. But when executed correctly, you have built a private credit system operating entirely within your own financial universe. Two additional instruments deserve mention because attentive people overlook them constantly. A home equity line of credit used for investment purposes rather than consumption provides access to capital at rates typically well below most other borrowing available to a private individual. When proceeds are deployed into investment activity, the interest may be deductible against investment income, which is often a more valuable deduction than standard mortgage interest treatment. The government is partially subsidizing your cost of capital. That subsidy should not sit unused. A securities-backed line of credit allows you to borrow against a portfolio of publicly traded securities without selling a single position. Your holdings maintain full market exposure and continue compounding. You borrow against the portfolio's value, deploy the capital, repay the line, and the original investment thesis continues exactly as before. No taxable sale, no disruption to compounding. The asset keeps working while you access liquidity against its value. Now let me tell you what is actually happening at the level of principle when someone builds a financial life around these tools. It is not cleverness. It is the sustained application of one idea that Graham articulated more clearly than anyone before or since. Price and value are different things. Most people pay the full market price for capital access. They pay banks for loans. They pay credit card companies for revolving credit. They do this not because they analyzed the alternatives and concluded it was optimal, but because it is the default, because the path of least resistance runs directly through institutions that profit from their participation. The disciplined investor asks a different question. What is this capital access actually worth? What would it cost if sourced from within my own ecosystem? What is the gap between what I am paying and what I should be paying if I understood my own balance sheet clearly? That gap is the opportunity. The life insurance structure most people walk past because of a reputation it accumulated through decades of misuse. The retirement account loan most people avoid because they conflated it with a withdrawal that carries completely different consequences. The private intercompany lending structure most people never encounter because it lives exclusively inside the offices of advisors who serve families wealthy enough to have built multiple entities. The home equity facility sitting dormant as emergency-only capital, the portfolio-backed credit line nobody draws on because nobody thought to ask whether it existed. Every one of these is a mispriced asset, not in an equity portfolio. In the architecture of your own financial life, Graham wrote that the investor's chief problem, and even his worst enemy, is likely to be himself, not the market, not the institutions, himself. The reflexive reactions, the unconsidered defaults, the quiet acceptance of whatever financial system is already in place simply because examining it requires time, attention, and the willingness to learn something that was never taught. You have now done that learning. the capital you protect this year by keeping interest inside your own system. The structure you build correctly this decade by organizing entities with the architectural intentionality that Graham brought to every balance sheet he ever analyzed. The compounding that begins the moment capital stops leaking through default arrangements and starts circulating within a system you control. That is the foundation of something that outlasts any single investment decision you will ever make. Graham built his entire body of work on one conviction. That knowledge, applied with patience and discipline and the willingness to act when the analysis is clear, is the only durable edge that exists in finance. Not market timing, not privileged access, not luck dressed up as skill. Knowledge, understood deeply, applied consistently, compounded over time. You now have that knowledge. What you do with it is the only question that remains. And if what we covered today shifted the way you think about how capital actually works, share it with someone who needs to hear it, because the gap between the people who understand these tools and the people who do not is not permanent. It closes the moment someone decides to look at their financial life the way Graham looked at every balance sheet he ever studied. With clarity, with rigor, and with the absolute refusal to accept the market price as the final word on what something is actually worth.